There is a quiet, devastating realization echoing through the households of hard-working people all over the world right now. You wake up early, you go to work, you pay your taxes, you try to put a little money away at the end of the month. You do not live a life of extreme extravagance. You are, by all traditional definitions, doing everything exactly the way you were taught to do it. You are playing by the rules your parents and your teachers laid out for you. And yet, every single month, the walls seem to be closing in just a little bit more. You look at the price of real estate, and it feels like a cruel mathematical joke. You look at your grocery receipt, and you wonder if there has been a mistake at the register. You look at your savings account, and despite the fact that the nominal number is slowly creeping upward, the actual power of that money, what it can actually provide for your family in the real world, is shrinking right before your eyes. I have spent the better part of 8 decades analyzing the architecture of wealth, the cycles of the global economy, and the invisible forces that silently transfer money from the working class to the ownership class. I am telling you today, with absolute mathematical certainty, that you are not imagining this struggle. You are not failing because you lack discipline, and you are not falling behind because you buy a coffee on your way to the office. You are failing because the rule book you were given has been burned. We have entered a period in economic history that I call the silent default of 2026. The macroeconomic environment has structurally and fundamentally shifted. The strategies that built the middle class in 1996 or even 2016 are no longer just obsolete, they are actively toxic. If you continue to cling to the financial advice of the past, you are walking blindfolded into a buzzsaw. Today, we are going to have a profoundly uncomfortable conversation. I am going to tear down the illusions that keep you trapped on the treadmill. I'm going to expose the financial traps of the modern economy, the behaviors that look responsible but are actually destroying your future. And then I'm going to replace them with the exact unyielding blueprint that the truly wealthy are using right now to shield their fortunes from inflation and multiply their net worth while the rest of the world panics. This will be a long, dense, and demanding masterclass. It requires you to abandon your ego and look at your balance sheet with cold, clinical objectivity. But if you have the discipline to stay with me until the very end and the courage to execute the protocol I am about to share, you will completely rewrite your financial destiny. Let us begin by dissecting the beast. Why is the rulebook broken? The entire global economy runs on fiat currency. For decades, the middle class was told that the ultimate symbol of security was a pile of this currency sitting in a bank account. But in 2026, we are living through the consequences of an unprecedented expansion of the money supply. Governments around the world have printed trillions upon trillions of units of currency to fund deficits, fight crises, and service insurmountable national debts. The United States national debt has exceeded $34 trillion. In the United Kingdom, government debt has surpassed £2.6 trillion. When governments have too much debt, history shows they rarely pay it back honestly. Instead, they inflate their way out. They allow the currency to lose value so that the debt becomes easier to manage. When you print money out of thin air, you do not create new wealth. You simply dilute the purchasing power of every single unit of currency that already exists. It is the inescapable physics of supply and demand. The US dollar has lost over 96% of its purchasing power since the Federal Reserve was created in 1913. The British pound has followed a similar trajectory. This is the invisible tax. It is a systematic, unlegislated confiscation of your stored labor. When you work for 40 hours, you trade your finite, irreplaceable human lifespan for currency. If that currency is depreciating rapidly in real terms, the system is silently stealing your life force. The average American has approximately $65,000 in savings. In the United Kingdom, the average household has about £17,000 set aside. Most of this money sits in traditional savings accounts, earning somewhere between 4 and 5% interest. That sounds reasonable until you understand what's really going on. Inflation over the past 4 years has cumulatively exceeded 20% in both America and Britain. That means if you had $100,000 in 2020, the purchasing power of that money has dropped to approximately $80,000 in real terms. You didn't spend it, you didn't invest it badly, you just let it sit there being responsible, and you lost $20,000. This is the macroeconomic reality of 2026. You cannot vote it away, you cannot complain it away, you can only adapt to it. And to adapt, you must purge 3 specific, devastating traps from your life. The first trap is the hoarding of melting ice. The greatest financial sin of the 2020s is the belief that cash is a safe long-term investment. The financial industry loves to sell you the illusion of the high-yield savings account. They proudly offer you a modest return on your money, and you feel brilliant for taking advantage of it. You log into your account, you see the interest payment deposit, and your brain releases a hit of dopamine. But you must look at the math. If your bank pays you a fixed yield and the real rate of inflation, the actual cost of energy, food, housing, and healthcare is rising faster than that yield, your safe investment is generating a guaranteed negative real return. You are paying the bank a fee every single year for the privilege of holding your money while it evaporates. Cash in a savings account is not an asset. It's a temporary parking spot that's leaking value every day. The wealthy do not hoard cash as an investment. They view cash purely as a temporary holding tank, a logistical tool used to facilitate daily transactions, and a strategic reserve of ammunition waiting to be deployed when the market presents an opportunity. You must transition your mindset from a hoarder of paper to an accumulator of hard, productive assets. You must own things that central banks cannot print. Real assets are ownership stakes in productive enterprises. When you own shares in a company, you own a piece of a business with employees working every day to create value. You own equipment, inventory, intellectual property, customer relationships. These real assets tend to hold their value and grow even when currencies decline.
Let me be absolutely clear. You must maintain strategic liquidity for opportunities and emergencies. I always keep cash available, even though I know it loses purchasing power over time. Not because I love holding cash, because cash gives you options when others have none. In every market downturn, the best buying opportunities appear. Great businesses go on sale. Assets that were expensive become affordable. But you can only take advantage if you have available capital. I recommend maintaining at least 6 months of essential expenses in highly liquid form, not invested, not tied up in assets that could take months to sell, available immediately. This isn't money you're investing. It's insurance. It's buying power for emergencies and opportunities. Yes, this cash will lose some purchasing power to inflation. That's the cost of security and optionality. It's worth paying. But anything beyond that shield must be sent out into the world to work for you. The second trap is the worship of the linear wage. From the time you're a child, you're asked what you want to be when you grow up. The expectation is that you will find a job, secure a salary, and trade your time for a paycheck until you are too old to work. In a stable economic environment, a salary is a wonderful thing. In an inflationary environment like 2026, relying solely on a salary is financial suicide. A salary is linear. It is tied entirely to your physical presence and your endurance. You cannot work 25 hours a day. Your earning potential has a hard biological ceiling. Furthermore, wages are the notoriously stickiest part of the economy. They are the last thing to adjust to inflation. Corporations raise the prices of their products immediately to protect their profit margins. They raise their employees' wages only when they are absolutely forced to, and almost never enough to outpace the true cost of living. If your only source of income requires you to clock in, you are entirely exposed. You're fighting a war on a battlefield where the enemy has infinite reinforcements. You must break the link between your time and your money. You must build or acquire systems that generate cash flow whether you are awake or asleep, healthy or sick, working or resting. You must become an owner. For most people, the simplest way to own productive assets is through low-cost index funds that track broad market indices. You don't need to pick individual stocks. You don't need to follow markets obsessively. You simply need to own pieces of many businesses and hold them through all conditions. This is the secret of the wealthy. They do not work for money. They command armies of dollars to go out and capture more dollars. You must systematically convert the linear income of your salary into the exponential income of your portfolio. The third trap is the normalization of indenture through consumer debt. We live in a society that has normalized financial servitude. The marketing apparatus of the global economy is designed to make you feel inadequate and then offers you a credit card, an auto loan, or a payment plan as the magical cure for that inadequacy. The middle class has been trained to completely ignore the total cost of an item and focus exclusively on the monthly payment. This is the architecture of modern poverty. When you finance a depreciating asset at astronomical interest rates, you are mathematically destroying your future. Compound interest is the absolute law of financial physics. When you invest, compound interest builds empires. When you borrow for consumption, it builds prisons. There is no legitimate investment on earth that will consistently guarantee you a 20% annual return. Therefore, if you are carrying credit card debt while trying to build wealth in the stock market, you are bailing water out of a boat with a massive hole in the bottom. You are paying the bank a premium to look wealthy while ensuring that you remain permanently broke. You must view consumer debt with absolute visceral disgust. It is a parasite feeding on your life force. You must attack it with unyielding aggression. Sell the car, cancel the vacations, cut the subscriptions. You must liberate your monthly cash flow from the banks. The truly wealthy use debt exclusively as a tool of leverage to acquire cash-flowing assets. If the debt does not put money in your pocket, you eradicate it from your life. We have identified the traps. We have diagnosed the illness. Now we must administer the cure. If you want to survive the wealth transfer of 2026, you must adopt the architecture of accumulation. This is the exact unyielding protocol that separates the permanent ownership class from the permanent renter class. Phase 1 is the ruthless expansion of the gap. Wealth is created in the margins. The speed at which you reach financial sovereignty is determined by one metric and one metric only: the gap. The gap is the mathematical distance between your take-home income and your living expenses. If you earn $100,000 a year and you spend $99,000 a year, you are poor. You have no gap. You have no soldiers to send out onto the battlefield of compounding. The average American household earning $70,000 annually saves approximately 3 to 4% of their income. That's about $2,000 a year. After accounting for inflation, their savings are essentially flat or negative in real terms. They're on a treadmill going nowhere. Wealthy households operate completely differently. They maintain savings rates of 20, 30, even 50% of their income, regardless of how much they earn. In 2026, you must attack the gap from both sides with relentless aggression. On the expense side, you must conduct a ruthless audit of your life. Eliminate the ego taxes. Stop buying things to impress people you do not even like. Drive a reliable used car instead of financing a luxury vehicle. Downsize your living arrangements if you are house poor. Cancel the subscription services you do not use. Frugality is not about deprivation. It is about the intelligent reallocation of resources towards things that actually matter, like buying your absolute freedom. On the income side, you must become a machine of skill acquisition. Do not ask for a raise. Make yourself so valuable that your employer has no choice but to pay you more, or the free market would gladly poach you. Learn high-leverage skills. Increase your income, but absolutely refuse to let your lifestyle inflate alongside it. Every new dollar of income must be funneled directly into the gap, and from the gap, straight into your ownership of productive assets.
Phase 2 is the systematic acquisition of the global engine. With your debts destroyed, your liquidity fortress built, and your gap expanding, you must transition from a consumer of goods to an owner of production. For the overwhelming majority of people, the most effective, mathematically optimal vehicle is a low-cost, broad-market index fund. When you buy an S&P 500 index fund, you are betting on human ingenuity. You are betting that tomorrow morning, millions of people will wake up and try to figure out a way to make their businesses slightly more efficient, slightly more profitable, and slightly more dominant. Over the past century, despite world wars, depressions, pandemics, and political turmoil, that bet has paid off spectacularly. You must automate this process. Human beings are terrible at making consistent financial decisions. We're emotional, we're easily influenced, we get tired and distracted. Every study of investor behavior shows the same pattern. People buy high and sell low. They chase performance. They panic during downturns. They get greedy during bull runs. The solution is automation. Set up automatic transfers from your checking account to your investment accounts on the day after you receive income. Choose your investment allocations once based on principles, not predictions, and then automate the purchases. The wealthy don't have superhuman discipline. They have systems that make discipline unnecessary. The money moves before they can talk themselves out of it. The investments happen before emotions can interfere. The plan executes automatically month after month, year after year, decade after decade. Phase 3 is the mastery of inactivity. Once your automated system is running, you must execute the most difficult strategy in all of finance. You must do absolutely nothing. The financial media will try to terrify you. They will scream about impending doom, geopolitical crises, and economic collapse. They do this to generate clicks and to force you to trade, because Wall Street makes money on friction, fees, commissions, and taxes. You must unplug from the noise. Understand that volatility is the toll you pay to travel the road of compounding. A 20% market drop is not a catastrophe. It is a temporary markdown on the price of great businesses. The stock market is a device for transferring money from the impatient to the patient. You must become the most patient person in the room. Right now, the S&P 500 is trading at valuations that have only been exceeded twice in history. The current price-to-earnings ratio of the S&P 500 sits around 27 to 28 times earnings. That means stocks are roughly 70% more expensive than their long-term average. I'm not predicting a crash. I'm warning you about impatience, because the next great opportunity won't reward speed. It will reward those who know exactly what to wait for. While headlines celebrate record highs, I'm doing the opposite. I'm holding more cash than ever in Berkshire Hathaway's history, over $330 billion waiting. That isn't fear, that's discipline. When the S&P 500 price-to-earnings ratio drops to 20 or below, I start getting interested. When it drops to 15 or below, I get excited. Right now, market sentiment indicators show extreme greed. That's when smart investors wait. Phase 4 is the intellectual moat. The final pillar of the architecture of accumulation is the one asset that cannot be inflated away, taxed away, or stolen. It is your own mind. I read every single day for hours. This isn't casual reading. This is 5 to 6 hours of focused reading daily. Annual reports, financial statements, newspapers, books, anything that expands my understanding of how the world works. This habit compounds like interest. Every day I go to bed a little smarter than when I woke up. Over decades, that daily improvement becomes an enormous advantage. In 2026, the market is ruthless. It pays for value, not effort. To have pricing power, to demand a high salary or high rates, you must be scarce. You must build an intellectual moat around yourself. You must learn skills that are highly complex and deeply valued by the marketplace. When you possess a skill that only a tiny fraction of the global population can execute efficiently, you possess absolute pricing power. You can dictate your own salary. Your personal earning power becomes the ultimate unbreakable hedge against inflation. I spend a significant portion of my day just sitting and thinking. No phone, no distractions, just me and my thoughts. Protect empty space, because that's when insight happens. The people who can actually sit with difficult problems and think them through have an enormous advantage. We are standing at a critical crossroads in economic history. The global financial system is fragmenting in ways we haven't seen since World War II. Geopolitical tensions between major economic powers are creating uncertainty that ripples through every market. Currency wars aren't longer theoretical, they're happening right now. Countries are actively trying to weaken their currencies to gain competitive advantages. When everyone races to devalue, the only losers are people holding those currencies. The rules that worked for your parents and grandparents are being rewritten in real time. But you do not have to be a casualty of this great economic shift. The rules of wealth creation are not a closely guarded secret hidden in a vault. They are simply unpopular because they require immense discipline, extreme sacrifice, and the willingness to look entirely foolish to your broke neighbors in the short term. You must take radical, uncompromising responsibility for your own balance sheet. No politician is going to ride in on a white horse to rescue you. No central bank is going to engineer a monetary policy that suddenly makes you rich without effort. The rescue operation begins and ends with the person looking back at you in the mirror. Audit your expenses tonight with a red pen. Kill your consumer debt as if your life depends on it, because your financial life does. Build your defensive perimeter of cash until it is impregnable. Direct every single surplus dollar into the ownership of productive, cash-flowing global businesses, and then have the unbreakable stoic fortitude to let time and mathematics do the heavy lifting for you. The path to absolute financial sovereignty is boring, it is remarkably slow, and it is absolutely guaranteed to work if you simply refuse to quit. The era of the fake rich is ending. The era of the rational accumulator is here. Which side of history will your balance sheet be on? Subscribe to this channel. We are going to continue navigating this volatile economic reality together. We will ignore the macroeconomic noise. We will focus exclusively on the mathematical truth, and we will build wealth that survives any crisis and lasts for generations. The storm may come. The storm always comes eventually, but you do not have to be caught unprepared. Build your system now, automate it now, and face whatever comes with the confidence that your money is as protected as it can possibly be. Let's get to work.